We did have one question about the wildfire impact. Mark, I know you talked about that, but maybe Tim, if you had any thoughts on how the recent wildfires might impact your forecast. I think that actually came in during your presentation.
Yeah, no, I'm sort of aligned with Mark on how we should be thinking about this. It's most likely in the near term. It's not. It's like a natural disaster. Things are shut down for a little bit, impacted, negatively, but you rebound fairly quickly from that. I think you're really more concerned about some of those longer run impacts that we're going to see. So I'm consistent with Mark's view on this topic.
Thank you. And I think during your presentation too, there was a question about corporate debt pre-COVID versus some of the numbers you were talking about kind of post-COVID. Any comments on that?
Right, and so I saw that comment, and what strikes me is that prior to the crisis, the pandemic, there were a lot of concerns about the surge in corporate debt being an accelerant during this next downturn. And I think the real takeaway should be that those concerns were not validated. Is that market seems to be much more resilient than I think the more pessimistic takes that we saw on that going into this crisis. And I think that really speaks to a more resilient financial sector than we had, say, in 2006, 2007. One thing I have noticed is this intense desire to try to repackage this crisis into the terms of the last one. And this is a completely different crisis, episode. And so I don't think we can really, again, lean on some of those past examples to give us a lot of hints about what's going on before. And as Mark said, a big change here is just the amount of fiscal stimulus that came into the system that is really unprecedented for the kinds of downturn we had.
Thank you. It's a bit of a long question I'm going to read here. Regarding fiscal stimulus, how much of an impact will that have on the long-term economy? Are higher taxes or changes to government funding anticipated to cover the stimulus? And if so, will that have an impact on the economy over the next few years?
So if Mark wants to give an answer to this too, I'll let him. But I'll start out saying that I'm not worried about the fiscal deficit or the debt issued until we have some kind of inflationary issues. That would signal to me that they were actually pushing against the productive capacity of the economy. Right now, we haven't seen that. If at some point in the future we start to realize that maybe the fiscal actions have pushed us towards some kind of productive capacity, and we see that inflation, then we're going to have to rethink about really how should we address that via taxes or spending realignments. But I'm not terribly concerned about that in the near term. That's more of a longer term issue from my perspective.
Mark, any comments on that from your perspective?
No, agreed. I mean, people clearly, debt overhang is a concern over the medium and long term in terms of borrowing costs and the like. But right now, government borrowing costs are certainly not an issue right now. So people are less concerned about the debt. And plus, it's also the right time in terms of the private economy being under capacity right now in order to take in the debt. The bigger concern would be what happened in the 7 or 8 years prior when we had the debt rising while the economy was running at full capacity. That's something that would be more of a long-term concern if we continue to do that in good times and bad times. If we continue to run up debt, at some point it will come back to haunt us. And just one comment on the first question in terms of the business debt, the concern that, well, what about all these leverage loans? And that potentially was what was could have been going wrong with the economy before we had the COVID shock. I'm still a little sympathetic to that. Again, this longer time dynamic has yet to come true. And the reason we could kind of write off the concerns about this corporate debt was that as huge and unprecedented a level of corporate debt as we had out there, it was not out of line with business sales. Because business were selling so much and bringing up so much income. So as long as the debt was in line with the income, that's awesome. Then doesn't matter how big the debt is, as long as the income can support it. Problem is, once we have this income shock and this recession, then it's possible that, the income can drop overnight, that debt doesn't go away, right? And so then it becomes out of line. And so as we go forward, if we do see at this, whatever, a lower sales rate, if we start to see, businesses fail as we go forward, then some of this could come home to roost over time. I don't think there's been time yet for a lot of firms to default on their debt, even if they're starting to have sales problems.
Thank you. We had a comment here, or a question here, that they've seen different takes on whether we'll be in for high inflation or, I guess as Tim had said in March, possible deflation. What do you see now?
This is Tim's backyard. I'll let him hit this.
So yeah, I saw that question come up too, and I did talk about the possibility of deflation and back in March, and I was particularly concerned about that because of the extent of the negative demand shock we seem to be suffering. Now, in the last couple of months, we've seen those inflation numbers pick back up much more aggressively than I would have expected. And again, that came through in the Federal Reserve forecast as well. So I'm less worried about a deflationary shock or a persistent deflationary shock than I was, say, 3 months ago. And this is really consistent with the idea that this economy is really bouncing back more quickly than than we thought. Now, I'm still not worried about sort of a high inflation environment. And when I think high inflation, I think like a 70s or 80s type of environment. In order to get that, you really need a sustained link between inflation, price inflation, and wage inflation. And we haven't been able to make that link for decades. So I would be thinking that maybe at best you get inflation up around 2, maybe about 2, a little bit above 2% on what how the Federal Reserve would measure it. And it would be hard to push beyond that without a real change in the dynamic of how we're dealing with the wage inflation, basically giving people wages to match higher inflation. So that's the in-between sort of ground I've been staking out. For me, that's important. I think maybe, and certainly in the heat of a crisis, you get caught up with the extremes, right? The extreme case of inflation or the extreme case of deflation. To me, just returning quickly to 2% inflation is fairly important, in that it shows how quickly the economy can heal. Plus, the Federal Reserve has basically promised, as much as they can, to hold interest rates at 0 for an extended amount of time. That means real rates, adjusting for inflation, are already predicted to be at -2% for an extended period of time, despite what we think of as pretty strong improvement in the economy. That sets the stage up again for very easy financial conditions going forward.
That's great, thank you. This one's for Mark, but I think it kind of builds on when you start talking about those kind of interest rates. Mark, do you see any indicators that Oregonians will be investing in capital projects, from the business community, or will we still see reticence and caution to hold back growth?
Yeah, right now I think it really depends on industry. I mean, in terms of business capital, one issue is a lot of our core employers, don't have the greatest business outlook right now. And, some of them, in terms of the aggregate capital spending that we see in Oregon, you add up, Intel, Nike, Boeing, and the associated metal makers and the like, and all of which have announced employment cutbacks and production cutbacks in recent weeks. That's gonna be an issue. Obviously, the airline being the biggest one, the Boeing stuff. There's probably not going to be a lot of investment there. And we look at other industries where Tim mentioned some of them that obviously may change given the nature of this recession. Every recession, there's a lot of churn, there's death and births of different industries, but there also usually accelerate some of these longer term structural changes in the economy. And here we probably will see acceleration going away from, bricks to clicks again. So your brick and mortar, retail, probably not a lot of investment there. Of course, your commercial real estate and your strip malls and office space, maybe not a lot of investment there. So there is some concern in terms of corporate investment. One maybe bright spot would be wood products. Wood products, the pricing environment is great, and if they could only get workers, they might be able to actually expand production for the first time in years and years and years. So that one's a positive, although boy, it's hard to predict building a new mill, but it is possible. Another concern I have is with regular restaurants and bars and the like. Now, Tim is absolutely right that the demand for that's going to bounce back in a lot of the leisure and hospitality. And we saw this long-term trend going into the coronavirus with fewer and fewer meals at home, more and more meals eaten out, more and more served. And that's probably going to continue. So the demand is there, but I can't imagine the credit availability will be. Very much like coming out of the housing downturn when we had a shortage of housing, but all of the lenders and regulators were once bitten, twice shy if you had too much housing in your portfolio, or if, and the like. And so we didn't see the credit flow, even though all these housing projects would have penciled out. And I fear the same thing might happen with restaurants and bars. There's always a ton of churn with restaurants and bars, and good times and bad. They close, they open. This time, I don't know if we're going to see as many open, just given that I imagine lenders are going to be a little bit scared.
And one of our, as much as the wood products industry is an opportunity for us, because we do have some strong players in that already here in the region and in Marion County particularly. We also have a bunch of producers that like to have their products sold through restaurants and bars. So we've been paying particular attention to that part of retail just because we have so many food processors and beverage companies that depend on those markets. Our friends at Business Oregon, Amanda Welker, had some questions on whether there's any analysis or any information on export trade trends.
Mark, I don't know if you have anything. I'm not. My big concern on the export side is, or the international side, is to what extent have we entering into some kind of new trade war or Cold War with China, and how does that impact really, where we source supplies from? That seems to be the big question that could, again, be costly potentially for businesses as they sort of realign supply chains to a new geopolitical realities. But other than that, I'm not terribly thinking there's a huge amount of churn going on in trade relations right now, in our trading partners right now.
Yeah, and unfortunately, a lot of the trade export-import data is a little bit lagged. But what we are hearing, of course, is that log exports dried up entirely. But that's not the biggest factor in terms of the value of our exports. It's really dominated by the tech equipment. And although we haven't seen it yet, I would expect that to be very strong going forward. While Intel has issues about its business model, there's no question that there's a big surge in demand for all sorts of tech products, given all of the remote learning and remote work that's going on right now. And so I would assume with their within firm trade, we're going to see some pretty good export numbers going forward just to satisfy that demand.
Oh, thank you. And we're winding up here. We have one last question from Nick Williams. Are there any early economic indicators relative to Oregon's gross receipts tax on the overall economy? So I think that would be directed to you, Mark.
Yeah, like I mentioned briefly, we're still flying blind on the commercial activity tax, because all we have now are two of these estimated payments. So we got in estimated payments, and they look to be about 80%, 83% of what we forecast, which, if accountants are doing their job right, because they only get penalized if they have this 20% cushion where they don't get penalized. And so if they're doing their jobs right, our forecast is online, but we don't know that. And I don't even think the accountants do until they sit down and actually fill out a tax return, which they won't do until, April of next year at the earliest. We don't really have a good idea of what's going on with that. But we, like I say, the numbers are in line with our estimates, a couple $100 million every quarter, which is lower than what was originally forecast by the Legislative Revenue Office when the bill was passed. But of course, that was pre-COVID world.
Right. Okay, well, thank you very much. I think that rounds up our questions that we've got here in the queue. I'd like to thank Mark McMullen and Tim Dewey for being with us today and joining us with your expertise. And obviously, this is a topic of interest to a lot of people. So we really appreciate your engagement and bringing your knowledge to the table.